High interest rates, tightened lending, banks saying no, but guess what? Smart investors are still closing deals. How? Creative financing. In this video, I'm going to break down 4 powerful deal structures that don't rely on traditional bank loans and show you how to use them. Let's start with one of my favorites, the master lease. A master lease allows you to lease the entire property from the seller and in many cases take over operations and cash flow without buying it up front. You agree to a lease payment every month. You may also negotiate a purchase option at a set price later. You step into the shoes of the owner. You collect rent from tenants. You handle expenses. You improve the NOI. When the time comes, you refinance or buy it outright. This is perfect when a seller doesn't want to take a price haircut. The property needs repositioning to stabilize NOI. Financing is tough to secure in the short term. Next, seller financing. This is where the seller acts as the bank. You agree to a price. They carry a note for part or all of it. You make monthly payments, just like a mortgage. Sellers say yes when they own the property free and clear. They want passive income without the tax hit of a full sale. They believe in the asset, but want to offload management. You can often negotiate better terms, lower interest, flexible amortization, even no payments for a few months. Structure is everything. Third, preferred equity. This is like a hybrid between debt and equity. A preferred equity investor comes into the deal with capital, usually to fill a gap between your loan and total project cost. They get paid a preferred return, say 10% annually, before the common equity sees any profits. Why use it? To bridge a funding gap, to avoid giving up major equity to partners, to boost leverage without adding senior debt, but it comes with risk. Preferred equity holders typically have enforcement rights if you don't perform. Know what you're signing. Lastly, blend and extend structures. This is more advanced, but can be a game changer in distressed deals. You work with the seller and lender to restructure the existing debt, extend maturity, or blend payments into a new agreement, often in exchange for an equity stake or management handover. This works best with institutional sellers or distressed sponsors who need a creative out. Bottom line, when the market gets tough, creativity becomes your capital. You don't need the cheapest debt. You need the smartest structure. And if you understand how to use master leases, seller carrybacks, preferred equity, and hybrids, you'll unlock deals no one else can. Want my creative financing cheat sheet? Download it below. And subscribe if you want more no-fluff, real-world CRE deal strategies. Because deals don't die in tough markets. They just change shape.